Something unusual is happening to Britain's housing market. Two cities can be just a couple of hours apart, yet in one, house prices are climbing. In the other, they're falling. Some places have buyers competing for every home that comes onto the market. Others are seeing properties sit unsold for months. So how can the same country have two completely different housing markets? The answer isn't simply interest rates, or inflation, or even the houses themselves. It's about something much bigger. A quiet shift that's changing where people want to live, where businesses are investing, and what buyers value most. If you understand that shift, Britain's housing market suddenly makes a lot more sense. For years, the story was remarkably simple. House prices almost always went up. Some areas grew faster than others, but the direction rarely changed. Buying property wasn't just somewhere to live. For many people, it became an investment that seemed almost guaranteed to increase in value over time. Cities expanded. Developments appeared on former industrial land. Commuter belts stretched further and further away from major employment centers. The assumption was always the same. Demand would keep growing. Then something changed. Not overnight, not because of one single event, but through several shifts that slowly began pulling the housing market in different directions. Today, Britain isn't experiencing one property market. It's experiencing dozens. Some cities are thriving. Others have slowed dramatically. A few are even moving backwards. The obvious question is, why? Most people assume house prices are controlled by one thing: interest rates. There's certainly some truth to that. When borrowing becomes cheaper, more people can afford mortgages. Demand rises. Prices usually follow. When rates increase, borrowing becomes more expensive. Some buyers wait. Others reduce their budgets. Demand cools. Simple. Except that doesn't explain why one city continues rising while another falls during exactly the same economic conditions. After all, both buyers are paying similar mortgage rates. They're living in the same country. They're affected by the same Bank of England decisions. So something else must be happening. And it is. Demand isn't created equally. Some cities are creating far more reasons for people to move there than others. Think about what usually convinces someone to relocate. A better job, higher wages, a university, improved transport, safer neighborhoods, better schools, a growing local economy. These things attract people, and wherever people move, housing demand usually follows. That's why population growth matters so much. If thousands of new residents arrive every year, but relatively few homes are built, competition increases. Prices rise. It's one of the oldest economic principles in the world. More demand than supply. But the opposite is also true. If fewer people want to move somewhere, or if more people begin leaving than arriving, demand softens. And eventually, prices begin slowing too. That's exactly what's happened in parts of Britain. Take London. For decades, it seemed unstoppable. Property prices climbed year after year. Owning almost any home inside the capital often looked like a winning investment. People stretched themselves financially just to get onto the property ladder, because they believed waiting would only make homes more expensive. Then, affordability reached its limits. For many first-time buyers, London simply became too expensive. Even relatively modest homes required enormous deposits. Monthly mortgage payments became increasingly difficult to justify. Then, interest rates rose. Suddenly, those already expensive repayments became even larger. Many buyers paused. Others gave up entirely. Some made a different decision altogether. If working from home was now possible several days a week, did they really need to live in London at all? That question has quietly reshaped thousands of decisions. Instead of paying city prices for a small flat, some buyers realized they could buy a larger home elsewhere, with a garden, a driveway, an extra bedroom, sometimes for significantly less money. That doesn't mean London is emptying. Far from it. But it does mean demand has changed. Not disappeared. Changed. And in property, small changes in demand can have surprisingly large effects on prices. The same pattern can be seen in several other expensive parts of southern England. Cities where prices climbed rapidly over many years are now facing a different challenge: affordability. There's only so much buyers can pay before they begin looking elsewhere. And increasingly, that's exactly what they're doing. But if expensive cities have started slowing down, where is all that demand going? The answer isn't one place. It's dozens. Across Britain, a new group of cities has quietly become the winners of this changing market. Take Manchester. For years, it has been attracting major employers, technology firms, media companies, and financial services. Thousands of graduates arrive every year. Many decide not to leave. The city has continued creating jobs faster than many other parts of the country. And where jobs appear, housing demand usually follows. Developers have responded by building thousands of apartments, yet demand has remained remarkably strong. It's a similar story in Leeds. The city has transformed itself into one of the UK's largest financial and legal centres outside London. Healthcare, digital businesses, professional services, universities, each brings more people, each creates more demand for homes, and unlike some areas where prices had already reached extraordinary levels, many buyers still see Leeds as offering comparatively good value. That matters. People don't just compare prices with the past, they compare them with the alternatives. A £350,000 home in Leeds feels very different if the equivalent property in another city costs £700,000. It's all relative. Then there's Bristol. For years, Bristol has combined a strong technology sector with engineering, aerospace, creative industries, and one of the youngest populations in the country. It's consistently ranked as one of Britain's best places to live. That popularity comes with consequences. Demand has remained high. Housing supply has struggled to keep pace, and prices have reflected that imbalance. But here's something many people overlook. Growing cities don't always have the cheapest housing, and falling cities aren't always the worst places to live. In fact, sometimes the opposite is true. Imagine two cities. The first has expensive housing, excellent schools, strong job growth, and thousands of people moving in every year. The second has affordable homes, but a shrinking population and fewer employment opportunities. Which one would you expect property investors to choose? Which one would young professionals choose? Which one would employers choose? The answers often reinforce each other. More jobs attract more people. More people create greater demand for homes. Greater demand encourages businesses to invest. That investment attracts even more people. Economists call this a positive feedback loop. Once a city builds momentum, it can continue growing for years. But the reverse can happen too. If major employers leave, young people move away, and fewer buyers enter the market. Housing demand gradually weakens. Not overnight, gradually. That's why two cities can head in completely opposite directions, despite sharing the same national economy. There's another factor, quietly reshaping Britain's housing market: universities. Every year, hundreds of thousands of students move across the country. Some leave after graduating. Many don't. Cities with large universities often benefit from a steady flow of educated young professionals who decide to build their careers where they studied. That creates long-term housing demand. It's one reason cities such as Manchester, Leeds, and Bristol continue attracting younger populations. Graduates find jobs. Friends stay nearby. Businesses recruit locally. The cycle continues. Meanwhile, cities struggling to retain graduates often face the opposite challenge. Young talent leaves. Demand leaves with it. Transport is just as important. A city connected by fast rail services, motorways, and airports instantly becomes more attractive. Businesses value accessibility. Workers value shorter journeys. Investors value both. When infrastructure improves, property markets often respond surprisingly quickly. One new railway station won't transform a city overnight. But over 10 or 20 years, better connections can completely change how attractive a place becomes. That's why transport projects are watched so closely by developers. They're not just building railways, they're changing where people choose to live. And then there's perhaps the biggest change of all: remote working. Only a few years ago, millions of people accepted long daily commutes as normal, an hour each way, sometimes more. It was simply the price of having a good job. Today, that's no longer true for everyone. Many employees now work from home several days each week. Some rarely visit the office at all. That flexibility has quietly expanded Britain's housing market. Instead of searching within commuting distance 5 days a week, buyers can now consider places much further away. Suddenly, a city or town that once felt too distant becomes perfectly practical. And that shift has redirected demand into places that were rarely considered before. The housing market hasn't simply slowed or accelerated. It's been redistributed. That's why Britain's property map looks so different today than it did just a decade ago. So, where does all of this leave Britain's housing market? The answer is somewhere in the middle. Headlines often make it sound as though the market is either booming or collapsing. The reality is far more complicated. Britain isn't experiencing one housing market anymore. It's experiencing hundreds of local ones. Move just 20 or 30 miles in either direction, and the picture can change completely. One area might be seeing fierce competition between buyers. Another could be recording price reductions on similar homes. That's why national averages only tell part of the story. They smooth out the differences. But it's those differences that really matter. Think back 20 years. Choosing where to buy a home often followed a simple formula. Live as close to your workplace as you could afford. Everything else came second. Today, that calculation has changed. People are asking different questions. Can I get more space? Will my children have better schools? Is there easy access to nature? Can I still reach the office when I need to? Is this somewhere I'd actually enjoy living? Those questions are shaping Britain's housing market just as much as mortgage rates ever could. Another trend is becoming impossible to ignore: regeneration. Some cities that struggled for decades are beginning to reinvent themselves. Old industrial districts are being transformed into apartment neighborhoods. Disused warehouses are becoming offices, restaurants, and cultural spaces. New transport links are opening areas that once felt disconnected. Investors notice these changes long before most buyers do. Because regeneration isn't just about improving buildings, it's about changing confidence. When people believe a city's future looks brighter, demand often follows. And when demand grows, so do house prices. Of course, none of this means prices will rise forever. Housing markets move in cycles. They always have. Periods of rapid growth are often followed by slower years. Sometimes prices fall. Sometimes they recover surprisingly quickly. That's perfectly normal. What matters is understanding why different places behave differently. The strongest housing markets usually have several things working in their favor at once: growing populations, diverse economies, strong transport links, new investment, good schools, universities, employment opportunities. It's rarely just one factor. It's the combination. Perhaps that's the biggest lesson of all. When people ask, "Where will house prices rise next?" they're often asking the wrong question. A better question is, where are people choosing to build their future? Because wherever jobs grow, wherever businesses invest, wherever families choose to settle, housing demand usually isn't far behind. That's the story quietly reshaping Britain. Not one giant housing market, but dozens of different local stories, each moving at its own pace. Some accelerating, some slowing, some only just beginning. And as remote working, regeneration, and changing lifestyles continue to reshape the country, that divide may become even more noticeable over the next decade. The map of Britain's housing market is being redrawn, not with dramatic headlines, but with thousands of individual decisions made every single day, where people choose to work, where they choose to raise a family, and ultimately, where they choose to call home.